Bloomberg Audio Studios.
Podcasts, radio, news.
Inflation is just becoming a very stubborn situation for the Fed.
This is too much for the Fed.
Inflation's not doing what they wanted on average, and this is a problem for them.
The sound that you heard there was the door slamming on a June rate cut. That's gone.
I do think it shuts the door on a June rate cut.
The Fed is not, in our opinion, is not going to be making any moves anytime soon.
They're more likely to hold status quo.
Pretty good reason for them to remain on hold here, see how things go.
A rate cut in June, it seems to me, would be a dangerous and egregious error.
At the moment, I think they'd probably set up for September and December, 2 rate cuts this year.
There's a real risk of no rate cuts. That's starting to come into the narrative, and I think that's new.
They're, creating a problem for themselves in terms of the promises of rate cuts, the inability to actually execute on them.
Those were some Bloomberg TV guests reacting to today's CPI print and whether or not it delays the Federal Reserve's path to cutting rates. Well, here on set to give her many cents is Penny Pennington, CEO and managing partner at Edward Jones. Penny, wonderful to chat with you. Thanks for being here.
It's a pleasure.
It's a great day because I feel like we're really finally recalibrating a higher for longer environment. I think we're looking at 1.5 cuts now, just based on expectations now in the market. How does that make an investor rethink portfolio allocation?
Well, you're right to ask me because I represent 8 million clients across North America, 19,000 financial advisors, $2 trillion of their assets that we are privileged to care for. 500,000 times a week, our financial advisors are meeting with their clients. And I asked a couple of our financial advisors this morning when we got the CPI print, what are your clients going to say when they come in? What are you saying to them? One of my financial advisors said, they're not asking about CPI, but we've been talking for a couple of years about their purchasing power. Their purchasing power day to day, their purchasing power for the long term. Day to day, Julia was just talking about car insurance rates have stayed high. Gasoline, food. It's a truism that what you bought at the grocery store 3 years ago now for $100 now costs $130. We are scenario planning with our clients for what higher interest rates and higher prices will mean for them, for all of their goals, for the retirement planning, for the shorter term spending that they want to do. We are seeing clients continue to spend retirement dollars for experiences. And this is one of the things I think that may be keeping service inflation where it is. An earlier report talked about summer travel is going to be very high. People are still spending money, and our retired investors are doing that.
I wonder if also part of the reason is that they can park their money in a 2-year bond now and then they get almost 5% yield, or just put it in a money market fund and get 5 or 6%. Are people actually doing that? They're parking their money and they're just taking the yield and going to do something with it?
Sure. You're getting rewarded for shorter term money today where you weren't 5 years ago. So that feels good. The risk in that is parking money at 4 to 5% when inflation is at 3.5% doesn't give you the long-term return that's going to help you meet your goals. So we always stress with our clients the proper allocation of their assets, cash, fixed income, equities, allocated appropriately for your risk tolerance, your time horizon, and the kind of goals, short, medium, and long term, that you're trying to achieve.
How does the higher interest rate environment and the idea that most people believe higher interest rates, at least relatively speaking, are kind of here to stay, how does that change the long-term planning?
Well, there's some puts and takes to that, right? So we're getting rewarded for the shorter term money. But if you're a parent or a grandparent who's thinking about, or a 30-something, thinking about buying a house, that's a different thing, right? So it depends on your goals. It depends on what stage of life you're in as to how you're going to see that higher for longer interest rate environment.
I am curious about some of the longer term trends that we've seen in investing with the individual investors. This sort of gravitation to private markets, the idea that at least on a risk reward balance that there's something maybe there a little bit more attractive than what you're finding in public markets. And we've already seen a lot of high net worth individuals really diversify into that private space. Are you seeing that trend sort of move down the line, the income spectrum?
Well, you're focusing on diversification, which I love, and you're focusing on the fact that a certain kind of democratization of assets and the ways to purchase asset occurs in our capital market system. That can be really healthy. So the traditional asset allocation of cash cash, fixed income, and public market equities still very sound and strong. But I read a statistic the other day, 92% of companies with $100 million of revenues or more are private. And so it's important that we continue to have a strong and thriving capital market system for capital creation. It is likely also to be important sooner rather than later that access to private assets become more democratized. What is going to be important, though, is clients understanding that client experience is a little bit different than buying a public equity or an ETF or a bond on the bond market. But I do see that coming probably sooner rather than later.
Do we know what percentage will be in those private markets? Like, part of me is also like, yeah, go in the private markets and then just pretend you're not going to get that money back because you don't know what it's going to do. We don't have any test cases really on this. How much would you recommend?
It depends on one's risk tolerance. When you think about liquidity as well, private markets are less liquid assets. When you think about that experience of how quickly do you need to draw your money out and how long-term are your goals, the private markets, less liquid and longer term in their exit, longer term in nature in the exit. So clients are just going to have to be very thoughtful about that, which means our financial advisors are going to be very thoughtful about that in advising them.
What do you think about Bitcoin and crypto?
Well, is crypto proven yet? No, it's not. And when we as a company advise clients based on the fundamentals of assets, based on their cash flows, their revenues, their ability to be sustainable, it's really hard to analyze cryptocurrency right now in that light. We are taking a bit of a wait and see approach at this point. Our clients are not purchasing crypto through us, but we are actively monitoring that situation.
I want to talk about the generational differences, if you will. I mean, are there generational differences? We keep talking about the idea of the boomers sort of aging out and this great wealth transfer, and then you have this younger generation of millennials and Gen Xers, which they always forget about us, and of course Gen Z, who have different priorities and are going to be coming into this investment landscape from a much different starting point than what the boomers did.
You're exactly right. When I think about, I'm a baby boomer. I'm the last year of the baby boomers, so I can channel that, but I can also channel my 30-year-olds. So the boomers and the silent generation are about to think about, they're in motion right now, moving their assets to the next two generations. Baby boomers and silent generation thinking about their long lives, remaining healthy in their long lives and having a great quality of life, while at the same time moving their assets to the next two generations. Very interestingly, we just did some research, and only about 30% of families are planning on having this conversation with the next two generations. That sets those families up for some real anxiety, and we found that out in our research, and perhaps some disharmony after mom and dad or grandma and granddad are gone. And so we would advise to, with your financial advisor, take the emotion out of this family conversation, but begin the process of talking about moving your legacy and your values. You don't have to talk about the dollar signs. This is what makes people uncomfortable sometimes. But talk about the legacy and the values that you want to pass on to the next generation. And then one final thing we found out, 68% of those who own the assets today would like to move them to the next two generations during their lifetimes. So a financial advisor helping a family scenario plan for a long life, making sure they don't run out of money, but the beauty, the joy of seeing your children and your grandchildren enjoy some of those assets during your lifetime is pretty special.
And hopefully do it in a tax advantage way.
Precisely. I'm about to have my first grandchild. My daughter is having her first child, so this is very real for me.
Oh, congratulations.
Thank you.
All right, Penny, it's been wonderful to have you. Penny Pennington, CEO over at Edward Jones.